wrong. That's how you become a master at the game. So, welcome to your class. Today, we're going to start from the very basics of trading, which I like to call Forex 101. When it comes to Forex, I always like to take it from the very scratch. So, I'm going to mute your mic now so that the training will be seamless. Seeing as I'm recording it, every class will be recorded, and then at the end of the class, I'll send you the recording, and you can watch it at your convenience. And when you find a point that is not clear, you can always send me a message on WhatsApp to ask me questions. When it comes to mentorship, it is one on one. I recently added you to that group just so that you get inspired, you get gingered by seeing other traders posting their chart. But mentorship is often one on one until you become very good enough to begin to share your analysis with the group, share your chart with the group, and ask people's opinion in the group. Then you can now begin to do that. But when it comes to questions as to basic questions with regards to your charting analysis, you send me a message privately on WhatsApp, ask me those questions, share the chart with me, and then I'll be able to guide you accordingly. So Forex 101. When it comes to trading, the reason why it's called Forex is because you're exchanging foreign currencies. So here you have the euro, you exchange it for the dollar. Here you have the dollar, you exchange it for the yen. So for every time you are exchanging one currency for the other, that's trading Forex. Here in Nigeria, we do it locally. We go across the street, see an aboki on the road, and ask, what's the current dollar price? Then he tells you that this is the dollar price, and then you can now begin to price it. You can now begin to say, okay, you're selling at 480. Why don't we go at 490 or even 500? Then he tells you no, that 480 is the best price you can get it for. So he sells it to you and you buy it. So for every time you're trading, there's always that exchange of buying and selling. So you buy one and you sell the other. That's the same thing you also do with the forex market. That's why it's always in pairs, because you are buying one and you're selling the other. You're buying the dollar and you're selling the yen. You're selling the yen and buying the dollar. So the minute you click buy, you're simultaneously selling. The minute you click sell, you're simultaneously buying, because it is being exchanged. So here you are now looking for an opportunity with this instrument, the United States dollar, South African rand. The minute you're looking that, okay, this instrument looks like it's going to be a good time to buy it, you're buying the dollar against the ZAR. So what you're doing is that you're buying dollar, you're selling ZAR. When you come into the market and you click buy, it means you've seen, which, based on data and other analysis, that the dollar will be stronger than the yen, than the ZAR. So it will make for a good buy opportunity. So when you buy it, you are making a profit. For every time the dollar continues to appreciate, you're making a profit. And for every time the ZAR continues to depreciate, you're making a profit. But what you're doing is you're buying dollar and you're selling ZAR. But what you did on your MT forward, that you clicked buy. But while doing that, you're selling the ZAR, right? So the reason you're doing that is because you've seen the structure, you've seen the technical analysis that dollar is going to be stronger. Now, when that decision is wrong, that's when your trade begins to go at a loss. So you bought the dollar and the ZAR against the ZAR, but here you are seeing that the ZAR is still stronger than the dollar. So you're seeing that play out in the market, in that the strength of the ZAR is better than the dollar, so it keeps pushing it down. Dollar keeps getting weak, it keeps dropping to 14, drops to 13, drops to that. So for every time it keeps dropping, your buy bias is wrong. So you want to exit your trade and wait for the best opportunity for you to take a buy. One of the mistakes that most traders make is that they expect the market to always go in their direction. The market will not always go in your direction. What you should expect as a trader is for your analysis to be right 85% to 90% of the time. Then the remaining 10% will be your risk contingency. When people say forex is risky, it's one of the biggest misconceptions there is, because forex is about one of the ventures that before you even go, you already know your risk. You already know how much you want to risk for every trade you're going into. So when I hear people saying that they've blown accounts and all, I just believe that these ones are trading according to the way the textbooks or the broker told them to trade and hope that it will turn out right. No, You don't need to blow accounts for you to become a good trader. All you need to do is just follow the rules of people who have done it before, and these people will guide you better. So you already know your risk, so there really is no point for you to blow an account. Why would you want to blow a $500 account or a $100 account when you've already decided that this trade I'm about to go into, the only money I want to lose is $10. I only want to lose $10, and my estimate or my target is $50. So you don't have any business blowing a $100 account when you already know that you're losing $10. So when $10 comes out of your $100, you're left with $90. So if your analysis is wrong, it means that you've only lost $10. But if your analysis is right, you've made $50. So you don't have any business blowing an account unless you are just trading the market as if you own the town. You don't own the market, you don't own the town. You are only coming into the market to look for opportunities. So for you to look for these opportunities means you're going in line with the market, you're following the market direction, you're following the market rule. As a trader, you want to be the most disciplined human being on earth. You want to be the most strategic and the most careful. You don't trade with the hope that it will be better. No, no, at all. Hope doesn't come into trading. And you don't trade with the grace of God, like by the grace of God. No. You trade that this thing, I've already seen all the things that I need to see, and that these are the reasons why this thing will work out 90%. Now, the remaining 10% probability that this thing doesn't work out, it will hit my stop loss and it takes me out. That's fine. That's strategy. That's discipline. So the only time you go into the market is when your 90% checks. If your 90% does not check, you don't go in to lose 10%. So you only enter the market when 90% checks out. Then after entering, you now set a 10% stop loss. And then that 10% of, say it doesn't go, is now your stop loss. And then what that means is that you're probably going to lose $10 depending on your capital or your trade size. So when you lose that small amount of money, you were able to enter again when the market is ready for you, because most times when you see a buy opportunity and you enter the buy and then the market takes you in for a loss, that does not mean that the market is not going for a buy. The market is going for a buy, but it's just not ready to buy at that time. So you exiting the market is for you to wait for when the market is ready. So the minute you exit, you're watching, you're waiting, you're observing. The minute that buy is ready, you go in. Last week, I bought USDs, but I wasn't ready to buy. The market kept selling. So I immediately exited the trade with $10 loss, and I was waiting for the market to give me an opportunity. So this week now, the market looks like it's ready to give me that opportunity, then I can take my buy. So that's how you begin to trade. When you're trading with that amount of discipline, with that amount of strategy, there will be no history, there will be no case of you are blowing accounts. You will only be seeing that, okay, you're taking some losses, but these losses are very minimal compared to the profits that you're making as a trader. So you want to be very disciplined, you want to be very strategic, and you don't want to trade like as if you are the one that is moving the market. You are not the one moving the market. In fact, I'm going to tell you for free that money you're bringing into the market does not even know that the money has entered. The market only knows that money has entered it when the money is as big as $1 trillion or as big as $1 billion. That's when the market knows that money has entered. When Bitcoin was just crumbling all over the place, people were just like, okay, Bitcoin, Bitcoin. The minute, what's this guy's name? This Tesla guy. Elon Musk, the minute he entered, Bitcoin felt the guy's presence. The minute all those billionaires entered the Bitcoin market, Bitcoin felt their entry. Now, the minute those guys move their Bitcoin from the market will feel their absence. So it is all of these big guys, all of these big banks. These are the guys that move this market. So when they enter the market feels it. So you, as a retail trader, with your $100, with your $500, with your $1,000, with your $2,000, even with your $10,000, you are following those big guys. You're following the major move of the market because it is their money that directs the market. Big banks like the JP Morgan, the Barclays Bank, and all of those big banks that operate the show, when these guys enter the market, it moves in the direction that they move it to. So you follow the money. That's what we mean by smart trading. You follow the money and you take your share. So following the money and taking your share is where strategy comes in. So when you see that the dollar has good data, you see it reflected in the market, and you will be able to take a trading decision with regards to that. Another basic thing that you also need to know about the market is that it moves in either of three directions. The market cannot move any other way. Like it doesn't move any other way, but in three directions. It moves towards the upside, which we call a bullish market or a buy market. It moves towards the downside, which we call a bearish market or a selling market. And then it begins to move sideways, which we call a consolidating market. When the market begins to move sideways, we call that a consolidation. So a consolidating market is not a market you trade. You don't trade consolidating market. You only trade market that is either moving up or is moving down. When the market is moving up, it means that you're looking for buy opportunities. When the market is moving down, it means that you're looking for sell opportunities. So for every time that the market continues to move up or down, you as a trader will follow that direction. So what do we mean by the market is moving towards the upside? So here is an example. Now, price finds a level here based off basic trading. You already know that there are levels called support levels and there are levels called resistance level. The support level is seen as the floor, the point where the market finds balance, the point where it has gotten to and it is stable, it is leveled, it is on ground zero. So you need to find that level, that support level, and then from that point, we expect price to push up. Now, when the market pushes up from that point and then it comes back, the market will always come back to do a pullback, a retest, a retracement, or let's just pretty much just call it what it is. The big banks taking profit, they've moved price, now they're taking their profit. So when they do that, the market drops, the market falls. So when the market falls like that, it's creating opportunity for you as a retail trader to find an entry. So when you find that entry, you now begin to take your trade. So how will you find that entry? It is by seeing that you're only taking positions at the point of pullback or at the point of retracement. So we're going to go into that when we begin to talk about retracement. But just so you know, the market does not move in a straight line. It doesn't move in a straight line graph. It always moves in what we call trend. So say the market is moving towards the upside, it pushes up, it drops, then it pushes up again and it drops, it pushes up again and it drops. So what you as a trader, the only thing you're looking for in a market like this is buy opportunities. You're only looking for buy opportunities. So at what point do you buy? You buy at the point where the market drops. You buy at the point where the market drops. You don't try to buy here. You try to buy here. You try to buy here. You don't try to buy here. You don't try to buy here. So you buy at this point where the market has done a pullback. It's about to continue. So that's how the market moves. It pushes up, it eases, pushes up, eases, pushes, eases. So like you can see here, this is a clear example of a downtrending market. So you need the market found level here, push down, it ease, push down again, ease, push, ease. So for every time the market continues to move in that direction, you will see it clearly. You see it clearly that this is a downtrend. You'll be seeing the market creating all of those levels, all of those levels, all of those levels, all of those levels, all of those levels. So now that brings us to what we call trends. So when the market moves sideways, we call that a consolidation. You see the market moving sideways. You see it doesn't have a clear direction. It's just moving sideways. That's a consolidating market or a market that ranges. I hope you're taking notes. That it's a video call doesn't mean you shouldn't take notes. You should always, always, always take notes, because taking notes, you can go back to read the notes, even though you're going to watch the video again. Still take notes, because note takers are money makers. Because when you take notes, it is that note that you will be able to use to create your trade plan. Because at the end of the class, you should be able to create a trade plan. So all of the notes you take it will guide you in creating a trade plan. So this is a sideways market, a consolidating market, or a ranging market. So markets like that, you don't trade this type of market. There is no trade here, because this one doesn't have a direction. It will just trap you. You'll be in profit loss, profit loss, profit loss, profit. So you don't have any. There's no clear direction. So ignore markets like that. Only trade the market that is either moving towards the upside or is moving towards the downside. So for a market moving up, you look for buys. For a market moving down, you look for sells. So now that brings us to the next aspect of basic trading, which is trend. So when we say trend, What do we mean? We mean market direction. That's just what we mean. We mean market direction. A market trend is a market direction. So what are the different trends? The uptrend or the bullish trend. So let's just call it uptrend so it's easier. So bullish just simply means buy, right? A buy market, a bull market, because most of them like to use bulls and bears. So bulls meaning that the market is charging towards the direction. Then the bear market means that the market is, is out for the kill, is killing people, is bleeding, like dropping, selling, and all of those stuffs. So a bullish market is a buy market, a bearish market is a sell market. So when the market is changing towards the upside, that's an uptrend. So how can you spot an uptrend right off the bat? When the market finds a ground level or a support level, it pushes up. Now, right after that push up, it will pull back. It will pull back. Now, that point where the market pulls back, that point right here is seen as a low. Now, this was the initial low that the market created, yeah? And then it dropped and found another support at this point. So this point where it finds another support that is different from this one is a low. But when you compare this low and this low, you would see that this low is higher than this low. So that means that this market is creating, why is it doing like this? Okay, excuse me, let me try and solve this. There's one bunkers. All right, so at the point where the market finds a support level, this point is seen as a low. So this was the first low, first support, and right here is another low, another support. But when you compare these two lows, this one and this one, you see that this one is higher than this one. So this one we call a higher low, right? We call this one a higher low. So when the market pushes up from this point and creates another low, we call this one also, it's still a low, but when you compare this low to this one, you see that this one is higher. So this right here is another higher low. So as long as the market continues to create lows that are higher than the previous one, we call that kind of market an uptrend. That's UP uptrend. So that's what we call markets like that, uptrends. The reverse is the case for a downtrending market. When the market sells, it pushes up. Now that push up is called a pullback. This one is called a retracement. We'll get that. Let's just talk about trend first. So now when this market pushes up, it finds a level. Now this was an initial level. This level right here is called a high. And this right here is another level, which is called another high. When you compare these two highs, you see that this high is lower than this high. So what does that tell us? It means that this is a lower high compared to this high. And then the market drops and creates another high. When you compare these two highs, see that this one is lower compared to the other one. So the market begins to create what? Begins to create lower highs. So now, why am I only talking about the highs and lows? Because as a trader, you are looking for entries from the low on a bullish market, while on a bearish market, you're looking for entries from the what? From the highs. Now, you will also consider all of these points. This point right here is called, this is a high. Compare this high to this high. You see that this high is higher. So this is higher high. This is higher high. And all that. Well, personally, I'm not interested in this with regards an uptrending market. I'm interested in the low. Why? Because this is the point where I'll be entering from. right? When I was learning to trade, they made us cram all of this irrelevant stuff, higher high, higher low, lower low, lower high. So it became confusing. Like, what are we doing? So sometimes I was saying higher low, lower high. We're just mixing everything up. But they didn't tell us what was important. What was important is that where you're looking for entries is from the low on the bullish market. So you want to take note of the lows. You want to make sure that this low doesn't take out this low. If this low takes out this low, you see a market like this, then you know that this is not a trend. This is just a chart pattern. It's not a trend yet. It's a chart pattern. The market hasn't given you a trend. It hasn't given you a directional move. It's just trying to adjust itself, trying to create a pattern. Which by the time we begin to talk about reversal patterns and chart patterns, you'll be able to understand these patterns that the market is creating. But on a normal market move, and the market begins to create all of these levels of low, as a trader, you are entering from these lows. You're entering from these lows. And for a bearish market or a downtrend, this one is called downtrend. As a trader, you're looking to sell from this point. So you're selling from the high, you catch this sell, wait for the pullback, and you catch this sell. So these are the two types of trends we have. The sideways trend is not a trend you trade, because when the market begins to move sideways, it means it is consolidating, it is ranging, there is no trade, there is no market there. Trading that kind of market will just stress you out and trap you. So you don't trade a trapping market, you trade a trending market. So these are the two types of trend, the uptrend and the downtrend. And you will see them clearly just by being able to spot the levels of the lows and the levels of the highs. So take a look at this trend right here. You see that this whole bead is a clear down trend, right? See where the market started from. The market pushed up. Now you can see this high compared to this high. See that this one is lower compared to this one. So this is a lower high. And then the market dropped, and then created another high right here. And you can see that compared to that, it is lower. So that's another lower high. And then it drops, creates another high. This right here is another lower high. Then it drops. So for every time the market continues, all of these ones, these are all consolidations. By the time we begin to study the um, trends in detail, we're going to understand, or let's just say waves. By the time we're going to wave theory, you're going to understand the reason why you're seeing these consolidations within the trend. So when you see stuff like this, you know that this market is clearly trending. So moves like this, you are not looking for buys, you're only looking for sells. That's what you're looking for as a trader. You're only looking for sells when you see a move like this. All right? So that's that for the trend. Now let's try to look for a market that is trending towards the upside. So if you're seeing a downtrend, let's try to see an uptrend. Let's just use this as an example. This is gold on the daily. I'm sure you know about time frames, right? I believe you should know about time frames. But the time frames is just simply the 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 different times, the different intervals of the market or of the chart. We have the 5 minute, the 1 minute, 15 minutes daily. It just simply means that the time it takes for one or each of the candles to open and close. That's what time frames is all about. The time it opens for each candle to open and close. So this is on a daily time frame. So it means that one candle per day, one candle per day, one candle per day, one candle per day. So for every time the candles are opening and closing, the market is moving in a direction, right? The market is moving in a direction. So now this is a clear uptrend. Market pushed up, dropped. So you, as a trader, you're looking for a buy from this point. So this is a low compared to this low. This one is higher. So the market pushed up again, creating another low. Compared to that buy, you already understand. So it pushes up like that, and it pushes up like that. So for every time price is pushing up, you are looking for buy opportunities.